So today we're going to open today's session with a keynote speech from Gary Gensler, who is at MIT, and he can mention the MIT Media Lab and what it does, but a lot of the work they're doing is very relevant to what we're discussing. And prior to this, I know Gary quite well when he was the chairman of the Commodities Futures and Trading Corporation, and I was chairman of the Australian Securities Commission, and then I guess we knew him very well from ICOs. So you probably saw the gathering as a bit like a gathering of old family members here. So and I'm really delighted. And then prior to that, Gary spent many years at Goldman Sachs. So he's a bit like me. He who also spent 30 years at Societe Generale. So we have both that investment banking background and regulatory background. So delighted to have you here, Gary. And usually he's pretty good at sort of ruffling things up a bit. So I think he won't surprise us today. So welcome.
Thank you. Thank you so much, Greg. It's good to be with you. It's good to be, I see Kona-san again.
Yep.
It's so wonderful to be back and to be back with other friends who I've seen in the past. I'm going to speak a little bit today about crypto finance. As Greg said, I'm at the MIT Media Lab. I'm also teaching at MIT. The Media Lab, a number of years ago, set up something called the Digital Currency Initiative, and that's what I'm advising. But can I start with a little bit of a thought exercise? Could I see around the room how many of you, by a show of hands, if you're willing to admit it, have ever bought personally a Bitcoin or any other crypto asset? Well, well, well. All righty. Your colleagues are now looking at you. All right. All right. So I have some crypto literate people in the room personally. Crypto finance is not a small field any longer. The asset class itself is about $400 billion, but highly volatile. This graph over time, by early 2017, was growing, but still modest. One might say in terms of world assets in the financial markets, 400 billion is still small compared to the many trillions of dollars, the tens of trillions of dollars of the overall financial markets. Let's see if we can keep that graph. But one thing I wanted to note, only about 40% is Bitcoin at this point in time. There are many other cryptocurrencies and tokens. I would also mention that the vocabulary in this space is not well established. So you'll hear words like tokens and might say, what is that? It might refer to a digital asset that is built on a smart contract, on something that's called an initial coin offering, and I know you spoke about that yesterday. Some people might use the word token even to use Bitcoin. But nonetheless, there's at least 1,500 to 2,000 of them that are trading at this point in time, and only about 40% of it is Bitcoin. Ethereum, which is used and can be used to not only send data on the internet, but can also use application code, is the second largest, and you can see the pie chart going beyond that. It raises a lot of public policy issues. And here we are at the OECD, so fundamentally an international organization that is dedicated to promoting social good and social good through public policy. This marketplace, to me, raises three buckets of public policy. Guarding against illicit activity, anti-money laundering, protecting our societies against terrorism financing, making sure that there's not tax evasion, and guarding sanctions where we have to put in sanctions. Guarding against illicit activity has been a challenge in this space. This space started in an area first with Bitcoin, in a sense, to be off the grid. Satoshi's seminal paper was in the middle of the financial crisis, and if one wants to sort of get their hands around this, recall that it was published in an American we celebrate something called Halloween. It was literally published on the day of Halloween in 2008 in the middle of the financial crisis because there was a lack of trust of central authorities, whether that be central banks or commercial banks, but a lack of trust of institutions. So in a sense, it was published in a way, and it's a technology that can foster a lot of illicit activity. But from the public policy perspective, we don't really want to shrink our tax bases, promote terrorism finance, promote drug financing, and the like. So these are a bunch of areas that are important, and I think probably your speakers yesterday and today would all say, yes, they would say we need to guard against illicit activity. But I'm going to come back to that because I think actually there's more that needs to be done. Financial stability, both in terms of the stability of central banking and, in a sense, the stability of commercial banking. There's some interesting things going on around the globe, particularly as to whether there will be direct retail deposits at central banks, what's called central bank digital currencies through the blockchain. In a sense, we already have some of this because commercial banks have direct digital deposits at central banks. It's usually called reserves. So the real policy question is whether that's going to be opened up to merchants and the retail public. But once that's opened up to the retail public, which I will predict will happen, somewhere, some country in the next 3 to 5 years will do this. It might be as soon as Switzerland actually has a referendum in June. Like the public of Switzerland are voting whether the retail public will have a direct access to their government's fiat currency digitally. It might happen in Sweden. I apologize if somebody from Sweden's here will tell me, no, this can't happen. But there's such little use of paper currency now in Sweden that it could be there. It could be in many other countries. China's looking at it closely as well. But that could destabilize the commercial banking system because then you'll have competition between direct retail deposits and the commercial banking system. And I would say the most important area of debate right now is protecting investing public. This $400 billion class of assets right now has a lot of scam and fraud in it. I'm seeing if I can get this to advance. I apologize. Maybe not.
IT.
Does anybody who invests in Bitcoin want to help me here?
It needs to go on the blockchain, doesn't it?
You need a talk?
It's not working.
Here, Greg.
The windows come up. So get rid of that.
Sorry. Can you keep speaking? And I'll try.
Well, I'll keep speaking.
We've got a technical expert. Excellent. We'll get it soon too.
We just wanted to advance a page.
Okay.
There you go. There's a new market called initial coin offerings. I apologize in advance because there's a lot of offerings. $24 billion have been raised to date in initial coin offerings. And you heard yesterday from a very established academic from our country, David Yermak. I'm sure that you heard from others. There's going to be a panel on initial coin offerings. I would say do not mistake this. These are investment schemes. These are investment contracts. I don't say that in a negative way. This is a new entrepreneurial way to raise money. The blue is Europe. The orange is North America, mostly the US, but a little bit of Canada. Green is Asia. And right in the middle, Venezuela purportedly raised $5 billion in a petro. We don't actually know if they raised the $5 billion. They say they raised it. They may not have. But I would say other than that $5 billion, these are real monies. This is about $19 billion. And you can see on the bottom, the graph, this is monthly totals. It has taken off in the last 6 to 8 months. And if anyone thinks that Jay Clayton and the Securities and Exchange Commission in the United States poured a lot of cold water and slowed this market down with their pronouncements. As Jay Clayton, who runs the U.S. SEC, said in February, he has not yet seen an ICO that is not a security under U.S. law.
Yeah.
By the way, I agree with him. I think anybody who says otherwise is probably hoping, or they have a conflict of interest and they're trying to raise money off of the public. I respect that. They want to be in an unregulated space. So what are these initial coin offerings? They have attributes of both investment and consumption. You will hear a term called utility token. But again, I would say do not mistake yourselves. A utility token can also be an investment scheme. It's not one or the other. And I think proponents of not regulating this space are trying to set up a false debate. Again, I think they're trying to set up a false debate. If it's a utility token or a consumption token, then don't worry, public sector, you don't have to regulate. I think that's a mistake because the public benefits from investor protection. And what's the basis of investor protection? It says there's full and fair disclosure. That yes, the investing public can take risk, but they actually should know something about that which they're buying. Secondly, anti-fraud protection. You can have anti-fraud in consumer laws, but we always, every country around this table has a higher standard of anti-fraud in investor protection than just simple consumer protection. This is not just going into a laundromat to get a token to do your laundry. It's more than that when somebody's raising $50 million or a couple of $1 billion, as Telegram just recently raised. Why? These are fungible and transferable tokens, similar to securities. They're generally issued before there's a functioning network. What I mean by that is there's no laundromat, but will you please buy my tokens? Or there's no theater. We haven't written the script. We haven't hired the actors or actresses, but please buy the tickets to the show. Thus, the purchaser is taking inherent investment risk. The promoters usually give themselves some allocation to begin with. Sometimes it's only a small, modest percent. Sometimes it's up to 80% of the tokens. Ripple is a company that has the third largest market capitalization. When they first started, they kept 80% of the tokens for their own company. That's not wrong or right. It's just a fact, but it's something that gives you an attribute that it's more like a security. They create scarcity through a preset monetary policy, not quite like central banks, but a monetary policy in the issuance of these tokens. And the development, while open source, is largely centralized. You'll hear debates about centralization versus decentralization. And I would tell you, even Bitcoin is more centralized than a lot of its proponents would like to suggest, but these ICOs are really quite centralized. The fraud is very extensive. One of my colleagues estimates at MIT that it's at least 25%. They did a review of over 1,000 tokens, but other studies say there's as much as 81%. And one study says that all initial coin offerings that were done in 2017, over 50% have already failed. That means some were frauds, some were just economically they failed. So where do these things trade? Well, they trade on new exchanges. I'll call them crypto exchanges. The blue squiggly line is the volume. It's currently running at about 20 billion US dollars a day. I think 2 days ago it was 24 billion, but don't trust the data. I know that the OECD is very focused on data for many, many things. This data may not be as good as this chart because these are unregulated exchanges by and large, and they can publish whatever they want to publish. There's a study out on the second largest one, OKX, that says they might be inflating their data by nearly 10-fold. But they're competing for market share. I would say, though, this exchange space, there's about 200 crypto exchanges with the big 10 or 15 competing. They're all generally less than 3 years old, and collectively, I believe they in aggregate might earn more than all the regulated exchanges. The London Stock Exchange, the New York Stock Exchange, the Deutsche Börse, whatever, you add them all up, this group, a number of these are probably making close to $2 billion a year. One exchange in Japan lost $500 million in a hack in January, and a 27-year-old who had started it just 2 years earlier didn't declare bankruptcy. He worked with the Japanese authorities, and he was able to refund the $500 million. Why is that? He had made that much money at this exchange just in last year. That doesn't mean anything other than these are growing fast, and they have very high margins and charge high fees to the collecting public. Exchanges can be both centralized and decentralized. The decentralized will be much harder to get your hands around, but the centralized have matching agents, they are counterparties, and they are custodians, as opposed to traditional exchanges. Traditional exchanges usually are not custodians because they use something called intermediated access. There's over 30 million direct members, but I think the number could be twice that. Just one US exchange has 20 million, but I'm using a conservative number here. There have been significant losses due to hacks because they actually have cryptographically in their own computers, like what Greg has in front of him, yes, they have something called the private keys. The private keys, once they're hacked, whether that's just in a traditional hack or some sophisticated cyber hack, they can be stolen. So what's the global approach to policy? Right now, I would say there is a growing consensus about guarding against illicit activity. It's not fully there with 180 countries around the globe. There are some countries that do compete. I'm not going to say anyone around the table, but there are some countries that do compete to be tax havens. There are some countries that actually want to promote illicit activity while not admitting that that's what they're doing. But I do believe that among the major nations around the globe, there's a consensus to guard against illicit activity, but it's hard. It's not perfect, and I think OECD and other international organizations can still do a lot to promote standards where there's consensus, helping tax authorities, helping finance ministries and this like. I think there's a growing consensus about monitoring for financial stability, but I would say there's some differing views. I've talked to some central bankers that are deeply worried, others that say, you know, this is still small. The Financial Stability Board has said it's still relatively small at $400 billion. But what we don't know is whether it could be a transmission vehicle to promote instability, especially because the crypto exchanges are not regulated by and large. Now, in some countries are moving forward. Japan, the US, others are starting to move forward to regulate the exchanges, but by and large, it's to regulate them to do what's called know your customer, anti-money laundering, and it's less about investor protection. I applaud any nation that it's willing to do that, but there's regulatory arbitrage. A number of exchanges are moving to Malta and other jurisdictions that are frankly just trying to compete to get the exchanges there. I would say they're trying to compete to get illicit activity and scammers. But that's one point of view, and you'll debate it yourselves. I think that Japan, the US, and some others are taking the right approach and are leaning into this to try to protect their investing public, but also to protect their tax base and protect against illicit activity. The harder topic is these initial coin offerings. There's really not much international consensus. I think IOSCO and BIS and this organization, OECD, has a role to play, the FSB, but I don't think it's an easy role. I think that nations will compete and have a different point of view, and on the one hand want to promote innovation, and on the other say, wait, we want to protect our investors, but also there's different laws and cultures. In the US, we happen to have a case go to our US Supreme Court in the 1940s around a bunch of orange groves in Florida. You don't need to know the law, but know this. The result of that Supreme Court case in the 1940s has gone back to the Supreme Court many times, and it still looks like most of these ICOs, if not all of them, are investment contracts under U.S. law, and the word investment contract comes under our securities laws. That is not the case in other jurisdictions. So in some jurisdictions, regulators are doing the right thing by the law because they can't actually get their arms around this. In the U.S., Jay Clayton can. But I would encourage any nation that can to think whether you go to your national legislatures and say, if somebody's raising more than a little bit of money, and they're raising it, asking purchasers to buy these things early, it's probably an investment scheme, and thus should be in some way protected. It doesn't have to be exactly the way you do securities law, but do not allow somebody to say, just because it's a pure utility token, no worries, this is just like a laundromat or a theater ticket. It has that attribute, but I don't know anywhere where somebody raises $1 billion for a laundromat. I just think that people are trying to have it two ways. And the reason is because you can raise a lot of money off of the public. It's a new form of crowdfunding. And the thing that it's most disintermediating is the venture capital world. The venture capital world raised internationally somewhere around $150 to $170 billion last year. This market might raise $30 billion this year, but I don't know. I don't know if it'll be $20 billion or $50 billion. It's still early. So it's starting to do that which other firms, venture capital, are doing. I think the path forward's not easy. Remediation of legacy ICOs and exchanges will not be easy. How to bring them inside, and I'm talking in the US mostly right now, or Japan that's trying to remediate, but any country that's trying to say, look, I'm not going to fine you for past practice, but let's come into compliance now. Custodial arrangement's terribly hard. Terribly hard because it's a new technology, but also because the exchanges themselves hold the money, and everywhere else, every exchange I'm familiar with, usually the funds are held at a regulated bank, a regulated investment bank, a regulated commodities merchant. Tracking beneficial ownership. Again, the OECD is interested in data. It's hard to track beneficial ownership in a world where everybody wants their privacy or pseudonymity. The blockchain is about anonymous beings. The technology can track beneficial ownership. There are technological solutions to attach for every what's called a public key. In cryptography, there are private keys and public keys, but the public keys are what are on the blockchain. You can attach to every public key beneficial ownership. There could be new certificate authorities or registries, and just like the international organizations have been involved in legal identity projects, LEI, there could be new projects in this space too to help on beneficial ownership. Decentralized exchanges will probably be a challenge for 2019 and 2020. It's already a little bit of a challenge now. A decentralized exchange is there's no center. It's just an algorithm on the internet where buyers and sellers can meet. Now, some of them do have human beings and companies, and some are like in Delaware or maybe in China. But others are not, and they're going to be hard. We will need to adapt our existing regulations and, of course, international regulatory arbitrage, which we talked about. My last slide, I promise you, I do think blockchain technology has a potential to transform the financial sector because inherently it's about moving data and it's applying code on a distributed network. And what is finance but basically distributing a form of data we call money and applying a form of code we call risk through a distributed network, humankind. I mean, finance basically distributes money and risk. The blockchain avails us to distribute data and code. So I think it can transform the financial sector, but I would say this, in many cases just simply that it will be a catalyst. It will be a catalyst, an irritant on the side of commercial banks and current exchanges to change, and even central banks to change their payment systems. So in the US, to move something, you could cost 2.5% to 3% to move something on the US payment system through Visa or MasterCard or elsewise. Well, that's a very high economic rent in our system in the U.S. So I think it will be an irritant and a catalyst on the side. In some cases, it will lower risk and cost because the disruptor will actually come in with a better product. But I think by and large, we'll still have commercial banks 20 years from now. Yeah. By and large, we'll still have central banks for a long time coming and the like. I think broad adoption, though, broad adoption of this technology will only happen if we bring this world inside of public policy frameworks. The social goods that we get from guarding against illicit activity, the social good of preventing in unstable times like the 2008 crisis, and the social goods, yes, in terms of investor protection and consumer protection, are real things and they go back centuries. And this new technology being folded in, just like the railroads were folded in, just like electricity and the internet itself was folded in at some point. And I think that's where something like the OECD plays a big role. So that's my thoughts. I don't know if there's any time for questions, but I'm glad to do whatever you want.
Okay. Well, thank you, Gary. That's very good.